If you've spent any time at all trying to learn how to trade, you've heard the golden rule. It's pounded into your head from day one as the absolute bedrock of survival. But what if that piece of advice, that foundational rule, isn't just a little off? What if it's actually holding you back? Okay, let's get into it. This is it, the one, the mantra you hear from every trading book, every guru, every single guide out there. Risk a small, fixed percentage of your capital on every single trade you take. I mean, it sounds smart, right? It sounds safe, and it's supposed to be the one thing that keeps you from blowing up your account. Because here's the problem. That rule, that one little rule, makes a massive and frankly a totally flawed assumption. It assumes that every trade you take has the exact same quality. And, if you just stop and think about that for a second, you realize that's just not true. So today we're going to take that rule apart, piece by piece, and build a much smarter way to think about risk from the ground up. Look, before you even start thinking about percentages or how much money to put on a trade, you have to start with the most important question of all. Where is my idea proven wrong? This has nothing to do with how much you stand to lose. It's all about the actual logic of your trade. So, your invalidation point, think of it as your line in the sand. It's the price or maybe a specific condition that if it gets hit, the entire reason you got into the trade is just gone. It's your logical exit point, and it has absolutely nothing to do with your profit and loss at that moment. And this, right here, is a huge deal. If you can't clearly state the exact point where your trade idea is wrong, then you don't really have a thesis. You just have hope. You're basically just clicking buttons and hoping for the best. A real trade idea has to be something you can test, and more importantly, it has to be something that can be proven wrong. And check this out. You can see how closely the idea and the invalidation are tied together. Your idea is level X is support, so you buy. What's your reason to get out at a loss? Well, it's when level X fails to act as support. See? The reason for getting in and the reason for getting out are just two sides of the very same coin. They have to be linked. This is just a brilliant little mental check you can do. A simple eye test. Just look at the chart, find the exact price for your stop losses, and ask yourself, would another smart trader actually want to buy right there? If you're getting stopped out of your long, right at a beautiful support level where someone else would be eager to buy, you've probably put your stop in a really, really bad spot. All right, so once you've figured out your invalidation point, based purely on the logic of your trade, then you can start doing the math. This is how we connect the why of your trade to the how much. But first, let's get two terms straight that people mix up all the time. Position size is simply how much stuff you're buying or selling, the number of shares, the number of contracts. Risk per trade is the actual dollar amount you'll lose if you're wrong and your stop gets hit. The whole game is to adjust your position size to control your risk per trade. And the calculation for this is actually super simple. Step one, you decide how many dollars you're willing to lose on this idea. That's your risk amount. Step two, you measure the distance between your entry price and your logical invalidation point. And step three, you just divide your risk amount by that distance. Boom, that tells you exactly what your position size should be. Let's just run through a quick example to make it real. Say you have a $100,000 account and you decide to risk 2%. That's $2,000. If your trade idea needs a stop loss that's 5% away from your entry, the math tells you to take a $40,000 position. Why? Because if that $40,000 position moves 5% against you, you lose exactly $2,000. See how the logic flows from the idea to the invalidation and then finally to the position size? Okay, so we've laid all the groundwork. Now we get to the really fun part, tearing down that old tired rule. Why is that fixed 1 to 2% advice so bad? And there you have it. Let's just be blunt about it. The idea that you should apply the exact same risk percentage to every single trade you take, it just doesn't hold up. It's a lazy, one-size-fits-all approach, and markets are anything but one-size-fits-all. So here it is, the core of the problem. The fixed risk rule treats a once-a-year, A+, everything is lining up setup the exact same way it treats some marginal, everyday 50-50 scalp. It completely ignores the quality of the idea itself, and that is a massive, massive mistake. I mean, when you put it like that, the answer is just so obvious, isn't it? Of course not. It makes zero sense to bet the same amount of money on your absolute best ideas as you do on your kinda meh ideas. If you do that, you're failing to properly press your actual edge when it appears.
So if a fixed number is the problem, what's the answer? Well, it's about moving away from a rigid rule and toward a flexible, intelligent spectrum that actually adapts to the opportunities the market is giving you.
The big idea here is really simple. Better setups deserve bigger bets. That's it. Instead of one fixed number, your risk should be a sliding scale. You risk more when your conviction is through the roof and the setup is super rare. And you risk way less when the setup is common and your edge feels kind of small. And this right here, this gives you a practical way to think about it. For those high-frequency, low-conviction trades that pop up all the time, yeah, you risk less on those, maybe 0.5% or even less. For your solid, everyday bread-and-butter setups, you risk a bit more. But for those rare gems, the no-brainer setups that only come around maybe a few times a year, that's when you should be risking the most. That's where your real money is made. And you know, this way of thinking, it doesn't just stop at how you enter a trade. It should guide every single decision you make, from the moment you get in to the moment you get out. It's about having a process, not just reacting to your emotions. Oh, this is a perfect example. We've all done it. The second a trade moves a little bit in our favor, we rush to move our stop to break even. It feels good, right? It feels safe. But is it logical? Does it have anything to do with your original thesis? Most of the time, the answer is no. You're just making a decision based on your P&L to make yourself feel better. And often, you just get stopped out on some random noise right before the real move happens. Okay, let's wrap this all up. What do you need to remember? First, your risk process starts with a logical invalidation point, not a random percentage. Second, get rid of the idea of fixed risk, because not all trades are created equal. Your job is to risk less on the common stuff and risk the most on those rare, high-conviction opportunities. And finally, every single decision you make, entry, exit, everything, should be based on your trade idea, not the little green and red numbers flashing on your screen. So I'll just leave you with this question to think about. I want you to take a hard, honest look at your own trading. Are your decisions truly based on a logical process, or are you just blindly following rules someone told you to follow, even if they don't really make sense? Because the answer to that question could be the difference between staying stuck and finally leveling up your trading.